The education loan system, a scam? The data no one shows you.
Welcome to Question Everything, where we challenge the status quo and dive deep into truths no one else dares to. Get ready to question everything you know.
Student loan is something which is meant only for students to get success in life. This is the biggest lie you were told about higher education. You were told college was the golden ticket, the path to a better life, a better job, and financial security. But for nearly 43 million Americans, it's become a lifelong burden, a massive, looming debt that follows them for decades. This video is not about whether college is worth it. It's about a system that seems rigged from the start. We're going to use real data to ask a crucial question. Is the education loan system a scam? The unstoppable rise of tuition. To understand the problem, we have to look at one thing: the price tag. Since 1980, the average cost of college tuition has increased by over 1,200%. Over the same period, inflation, the general rise of prices, has increased by only 300%. This massive gap is at the very heart of the crisis. Why this massive gap? Critics point to a single factor: the easy availability of student loans. When students can get almost unlimited loans, colleges have no incentive to control tuition costs. The price of an education becomes whatever the market can bear, and the market is flooded with borrowed money. The cost of a degree becomes disconnected from the actual value of the education. The unseen burden, a statistical breakdown. The result is a national debt crisis that has reached staggering proportions. As of mid-2025, the total amount of outstanding student loan debt in the U.S. is $1.814 trillion. This isn't just a number. It's a crippling burden on more than 42.5 million Americans, with the average federal student loan debt for a borrower exceeding $39,000. This debt is not evenly distributed. Racial disparities are a critical factor. The average federal student loan debt for Black borrowers upon graduation with a bachelor's is $33,960, the highest among all racial groups. Within 12 years of graduating, the average debt for Black women grows by 13%, while that of Black men grows by 11%. This speaks to a systemic failure where the financial burden is disproportionately placed on communities of color. Furthermore, more than 9 million borrowers were in default or delinquent on their student loans as of April 2025. This is a massive issue that directly impacts the credit scores and financial futures of millions of people, making it harder to get a mortgage or a car loan. This is a crisis that is no longer looming. It is here. The unseen mechanisms and proposed solutions. The problem with the system is in its design. Federal student loans are often non-dischargeable in bankruptcy, meaning they are a debt that is almost impossible to escape. This lack of risk for colleges and lenders has fueled a tuition bubble. It's a system where vast sums of money flow freely into the higher education industry, while only a small strained trickle of repayment flows back from the borrowers. The problem lies in the design of the system itself. Federal student loans are often non-dischargeable in bankruptcy, meaning they are a debt that is almost impossible to escape. This lack of risk for colleges and lenders has fueled a tuition bubble. What needs to be addressed in 2025? The system's flaws are now a central issue in national discourse, and several proposals are on the table. Project 2025 and the Save Plan injunction. One proposed reform is to eliminate existing income-driven repayment plans, such as the Save Plan, and replace them with a single, less flexible plan. This would raise payments for millions of borrowers, with a projected $2,761 increase in annual payments for the average earner between ages 25 and 34. As of mid-2025, a federal court issued an injunction preventing the full implementation of the Saving on a Valuable Education (SAVE) plan, leaving borrowers in a state of financial anxiety, and demonstrates the fragility of current relief efforts. A call for servicing reform. Experts also highlight the need for a complete overhaul of the student loan servicing system. A recent report notes that inadequate funding, that a broken application process are hindering borrowers' ability to repay their loans and are a primary driver of default. Smart choices for students, maximizing your return on investment. While systemic change is crucial, students can take concrete, data-backed steps to protect themselves. This isn't just about saving money, it's about making a smart investment in your future. Choose your major wisely. The average return on investment for a college degree is a 682% lifetime ROI. But this varies dramatically by field. For instance, degrees in finance have an average lifetime ROI of over 1,842%, while majors in fine arts may not provide the same financial returns, with a study showing that arts graduates with debt are 25% less likely to work in a job related to their major. Choosing a major with a high potential for earnings can make your debt manageable. Evaluate the institution type. All schools are not created equal when it comes to debt. Students at private for-profit colleges are the most likely to default on their loans, while those at nonprofit colleges have the lowest default rates. A 2011 study found that students from for-profit and two-year institutions accounted for 70% of all student loan defaults. Choosing a school with a good track record of student success and high graduation rates is a key factor in ensuring a positive financial outcome. Be smart about borrowing. Don't borrow more than you need. A study found that it takes an average of 11 years in the workforce just to break even on a bachelor's degree. Students can minimize their debt by living at home, using public transportation, and working a part-time job. Every dollar not borrowed is a dollar you will never have to pay back with interest. The government's role. Policy solutions for 2025. The money flowing into the system isn't a simple circle, it's a funnel. Vast sums are routed from government-backed loans directly to institutions, inflating tuition costs with little restraint. The system's design ensures colleges are paid in full with no risk. But for the millions of students on the other end, the flow is a painful struggle. The small, often fragmented stream of repayment from borrowers barely registers against the torrent that went out. It's a fundamental imbalance that has created a financial trap for an entire generation. The issue is far too large for students to solve alone. A multi-pronged approach from the government is essential to create a more equitable and sustainable system. Reform loan repayment and accountability. Bipartisan proposals have been introduced that would cap federal loans for graduate students and parents, which currently have no limits. The Student Protection and Success Act, introduced by Senators Shaheen, Democrat, and Young, would remove federal loan eligibility from colleges where less than 15% of students are able to begin repaying their loans within 3 years of leaving school. This holds institutions accountable for the financial outcomes of their graduates. Streamlined repayment plans. The current system of repayment is overly complex. Proposals suggest simplifying the repayment process by offering just 2 choices: a standard plan and a new simplified income-driven repayment (IDR) plan. These new plans would prevent a borrower's balance from growing over time, a major problem with previous programs. Encourage employer participation. Bipartisan legislation, the Employer Participation in Repayment Act, has been introduced to make the tax-exempt status of employer-provided student loan assistance permanent. This would allow companies to contribute up to $5,250 tax-free per year to an employee's student loans. The program would provide employers with a valuable tool to attract and retain talent while simultaneously helping borrowers pay down their debt faster. The bottom line: what is really going on? So, is the education loan system a scam? The data shows that it's not a simple yes or no. It is a system that, while intended to promote social mobility, has created a massive, unsustainable debt crisis. It has allowed colleges to raise prices with little consequence, putting the financial burden directly on the shoulders of students. Ultimately, the education loan system is not just a tool, it's a complex, multi-billion-dollar industry with its own incentives, and the data suggests that for a significant portion of the population, the promise of an education has become a financial trap that is a clear and present threat to economic stability in 2025 and beyond. So strict measures are needed anyway, as it is neither good for students nor for economy.
Your opinion is what helps us expand our knowledge. Please share your thoughts on the question we asked and let us know what we should investigate next. Don't forget to subscribe to Question Everything and hit the bell. Stay curious and keep questioning.